Sridhar, what do you do in terms of positioning right now? You know, at the start of the year, there was a lot of talk about how people should start getting out of defensives and start getting into cyclicals. Has all that gone out the window because of what's happened subsequently in the last few months?
Yeah, we didn't believe even beginning of the year that we should get into cyclicals because the ground reality was not even, we were not even seeing green shoots of any of those reasons why we should get into those sectors. So even now, I mean, we've met so many companies post results. I don't think things are looking that great. I don't think the capex cycle is coming back. Even consumption is slowing down. So I mean, there are very few places to hide right now, but surely not cyclicals. I mean, it's too early right now. That's our view. We could be wrong, but so far I don't see any green shoots at all.
A lot of the money we were attracting, though, Sridhar, was pure index ETFs, you know, just benchmarked with what's happening with the Nifty. Would you say there is a risk of deep corrections in some of the star sectors like the banks or the pharmaceuticals because of this money beginning to pull out? Also spaces where ownership has been quite high?
Yeah, so actually if you see, financials have actually underperformed this year. So even though a lot of money has flown in, it isn't as if financials are doing well. I mean, if you go back beginning of the year, most people were saying interest rates are going down. Go ahead and buy financials. If things were so easy, financials should have outperformed significantly because we've got 75 basis points of rate cut in the first 4 months itself. So yes, money has flown in. Some of the financials haven't yet collapsed as much. But I would say that there is a risk that there's a lot of ownership in financials. Maybe some of the private sector banks, because their earnings support is still there, may not fall substantially. But public sector banks, if the NPA situation continues, there is a risk. Pharmaceuticals earnings is still strong. Currency will also help. So I don't see people running away from that sector in a hurry. So there are only few pockets where you can hide right now. If the market comes off, every sector comes down, maybe pharmaceuticals will continue to outperform. So we continue to have an overweight position on pharmaceuticals, but underweight on financials.
Numbers are quite disparate, Sridhar. So just walk us through what it is that you have picked up in terms of what the outflow situation has been from ETFs, which have India exposure as well, and what by contrast has been the kind of money that some of these long-only funds have been able to pull that you were alluding to.
I haven't tracked them so closely, so maybe I won't be able to help much here. But I mean, we see the FI numbers on a daily basis. Keep in mind that India's index weight isn't that much in emerging markets. It's somewhere in the range of 7%. So when you see large ETF outflows, especially GEM outflows, the resultant impact on India is significantly lesser, whereas long-only funds tend to allocate substantially larger to India, because if you're underweight some of the large countries like China, Brazil and Russia, which on an aggregate account for maybe 35–40% of the benchmark, then you by default have to be overweight India. So I would guess that a lot of emerging market funds would still be overweight India. We are overweight India. But there are sectors where you can hide and still find some returns.
What is the risk, Sridhar, that people slowly lose interest in this asset class? Because 5 years is a long time. For 5 years in dollar terms, not to make any money in an asset class. I know it will be a very unpalatable truth for you as a money manager if that were to happen. But do you think it's training the patience of a lot of global investors?
Yeah, I think that's the risk for the sector, for the segment as such, the asset class itself. But as I said, as a long-only fund manager, so if you see ASEAN countries, there seems to be like a bull market going on. I mean, they've also corrected in the last 1 month or so. So similarly, there are certain pockets available in a few countries here and there. So it's possible for a long-only fund manager to maybe possibly allocate assets better. But it's only that much that you can do by moving assets from one country to the other. This asset class surely is at a crossroad, and a lot of these countries would need to do significant reforms, including India, to get significant interest back. So if the US market and some of the other developed markets are showing better returns, better earnings growth, you would see money flow into some of these countries. So that risk surely remains for emerging markets as an asset class.
Let me ask you about one question about the impact of the rupee, because it's been noted that because of the rupee earnings for many companies. Actually, the depreciation in the rupee is earnings positive for the Sensex companies. But do you think it's possible that because many of these companies have also been taken by surprise by the extent of the fall, that they could have been caught out by some of their hedges, and maybe the positive earnings impact is overstated because of hedging losses?
Yeah, I think the positive earnings impact is surely overstated. Keep in mind that a lot of these companies who have overseas borrowings do not pass a lot of the impact through the P&L. They just pass it on the balance sheet. So the true impact is never seen. And there are many companies who are sitting on hedges because they didn't expect currency to depreciate so fast. But even with that, barring a few sectors here and there, I think on an average, I think the impact will be broadly neutral to I would say marginally negative. So I wouldn't say that currency depreciation is great for Indian companies. A lot of the Indian companies have overseas subsidiaries these days, and as a result, when you are doing a consolidation of their earnings, it actually has a negative impact. So I wouldn't be so positive just because currency has depreciated from earnings standpoint. Also keep in mind that beginning of the year, most analysts just roll over the numbers and say, hey, we're going to get 15% earnings growth next year. I mean, last quarter we got almost zero earnings growth on an aggregate. The previous quarter was negative. I don't see how we're going to get 15% earnings growth next year. And having met so many companies recently, I can tell you that the June quarter is looking worse than the March quarter. So I think the earnings numbers itself at this stage are exaggerated, and we would see significant downgrades to some of these numbers
that we expected. So Sridhar, given the points you were just making, tactically, how would you approach the market? I mean, assuming the worst is to come and we get back to the lows we've seen in the recent past, basically breach this 5500 zone, tactically, what kind of approach would you have then to the market?
So you stay in defensive. As I said, if the markets fall, there's no place to hide. Everything will fall. Possibly you're trying to, protect your portfolio by ensuring that it falls lesser. So sectors like, say, a telecom, or pharmaceuticals, IT, staples to some extent, and private sector banks. And barring this, rest, one has to look on a case-to-case basis. But I don't think things are looking that great in the near future. Possibly maybe second half, if things start to improve, global outlook starts to improve, that will reflect in India. But as we speak, in the near term, things are not looking that great. So you're better off with defenses rather than trying to take a very aggressive call and trying to bottom fish some of these beaten down cyclicals or infrastructure plays or even PSU banks for that matter.
Sridhar, always good talking to you. Thank you very much for dropping by today. That's Morgan Stanley with its view on the market.